Hi, I'm Jeni Browne, Sales Director at Mortgages for Business. I wanted to give you a brief update on the buy-to-let mortgage market just to inform you of the changes that we have seen over the last few months. First of all, I just want to touch on interest rates, and it will come as no surprise to you when I say that interest rates have been increasing across the board, and the buy-to-let market is no exception to that. So what we have seen is that essentially mortgage rates, mortgage costs have increased by circa 1% since January of this year. Now, why is that? So first of all, we've obviously seen the Bank of England base rate increase its interest rate a couple of times now, but also the cost of funds on the money markets, the swap rates have been increasing as well. And where lots of lenders do rely on the wholesale money markets for the funding of their mortgages, when their costs go up, these then get passed on to the borrower. Now, in terms of what this means for you, so if you are going to be in the market for a remortgage, it might be worth bringing forward your plans to consider your options. So some mortgage offers are valid for up to 6 months. So if you think about it in terms of timing, if you take circa 6 weeks to obtain a mortgage offer, and then that mortgage offer is valid for a period of 6 months, and that means that realistically you've got, you can apply for a mortgage 7.5 and even 8 months before you're actually going to need to draw down on it for your remortgage. So one thing you can do if you have a mortgage ending this year is actually make an application now to secure rates at today's pricing, because the expectation is that throughout 2022 things are only going to go up. Depending on which industry expert you're listening to, they expect base rate to end at between 1.5% and 2% by the end of this year. Now, one of the unintended consequences of interest rates increasing is that some lenders have taken the opportunity to review their rental calculations. The rental calculation is essentially the affordability calculation when you apply for a buy-to-let mortgage. So what lenders will often say is, to make sure the mortgage is affordable, we would need the rent to be, as an example, 145% of the mortgage interest payment, assuming a notional interest rate of 5.5%. And there's lots of variations on these. This is just an example for you. Now, because the interest rates are going up, rather than just continuing to use the same notional interest rate of, say, 5.5% that lenders have been doing more recently, what lenders are saying is, well, actually, that now has changed. The interest rates have increased. So actually, we're going to increase that notional rate. So what would have been 145 at 5.5% has, for example, moved up to 145 at 6%. So the fallout of this is that you have landlords who can borrow less per pound of rental income than they could do previously. Now, the first thing to say here is that not all lenders are making this change, it's only some of them. They have some real flexibility to decide whether they do or don't implement these changes at the moment. So that's not necessarily, it's not like all lenders have changed their rental calculation, but just know that some are doing this. And unfortunately, when some start doing it, other lenders will invariably take a look at their criteria and say, well, hang on a minute, if these guys are doing this, should we be doing the same things? It's like a domino effect. So at the moment, we're okay, but there is going to be, I suspect, more lenders following suit in the future. So I think, again, in terms of protecting your position, so one of the things you can do, it comes back to this remortgaging early and getting in there on today's pricing and also today's criteria. If you're looking to buy a property going forward, how is this going to impact you? Well, actually, I think what's good news is that we're seeing that rental yields are increasing across the board. So actually, you may find that you're largely shielded by the fact that rents are on the increase. But going forward, it's really just something to keep in mind in terms of what's happening there. Now, just moving on to mortgage lending criteria more broadly. So what we find is that the lenders are now reconsidering their lending criteria. Obviously, mortgage rates are going up, so they're feeling a little bit kind of spooked. The lenders have had a great couple of years, right? It's been very, very easy for them. But now they're sort of facing the future and thinking, well, our pricing is going up, the housing market is going to probably slow down. So what can we do to kind of shore up our position and ensure that we continue to lend healthy levels of money? So what they do is they start to turn their sights to their lending policy to see how they can kind of expand things, push on their risk appetite a little bit to try and broaden their criteria to try and entice more borrowers in. Okay, so where are we? So at the moment, the maximum loan to value on any buy-to-let mortgage sits at 85% loan to value, but there is only one lender playing in this space, and it is incredibly expensive. So this would really only be suited to ultra high yielding properties, where they can really afford to absorb that very high interest cost. More ordinarily, we are seeing borrowers sitting at 75% loan to value. The 80% rates aren't bad, but actually I think 75% is where things are what I would class as palatable. We really are back to pre-COVID lending conditions. So during COVID, we saw lenders doing things like reducing loan to values, not lending on student lets, that kind of stuff. All of that has gone away now, so we really are back to kind of pre-COVID times in terms of lending criteria. And interestingly, what we are seeing now, as I mentioned a moment ago, is that lenders are really looking to expand their criteria. So I mentioned earlier on we've seen the rental calculations changing from some lenders, but actually conversely to that, most lenders are making kind of what I would class as more positive changes. So as an example, we're seeing lenders increase the maximum number of rooms or self-contained units they'd accept on HMOs and multi-unit blocks. There's been a little flurry of maximum age increases, so the maximum age at maturity of the mortgage. So some lenders were, say, 75 years old, they've moved it up to 80. We've seen some lenders increase their appetite on new builds by increasing the maximum loan to values there. And the other thing that we've seen quite a few lenders do is remove their minimum income requirements. So generally what traditionally has happened is that some lenders would say to access a buy-to-let mortgage of any level, be it £50,000 or £5 million, you need to earn £25,000 a year. And other lenders have said, well, actually, we don't mind how much you're earning as long as you're earning something, and we can be comfortable that your financial position is secure. So, you haven't got lots of unsecured debt and a massive home mortgage and that kind of stuff. So what we've seen is some of the lenders who have originally had this £25,000 criteria remove that criteria. And I think, why is that? I think because they've realised that it's nonsense. If someone is earning £25,000 a year, that doesn't mean that actually they're any more or less risk as a landlord for a buy-to-let mortgage, because the whole expectation is that the rent pays the mortgage, not the landlord themselves out of their own affordability. And these lenders who have made these changes have been some really sort of large high street institutions. And I do expect more changes like this to kind of trickle in over the coming weeks and months as the housing market does really start to slow down and lenders are looking much harder for some new lending opportunities.